Hi everyone, welcome to Jedi episode 10. My name is Jimmy and with me today are Ethan and David. For those of you who tune in to our Facebook Live for the first time, and if you want to know more about us and the name Jedi, do check out our first episode in the video section. I'll be the moderator for this episode, so here's how we're going to run through. We will first address questions that were raised during the previous episode on CPF hacks part 1. Then Ethan and David will be having a fireside chat on CPF hacks part 2. And then there'll be a bonus section on why multi-pay critical illness policies are actually early stage and the normal critical illness policies packaged as one. Then last but not least, we will have a Q&A section. So feel free to post your questions in the comment section below and we will address them during the Q&A section. So without further ado, we will start with the questions that were raised during the previous episode. So I let Ethan start the ball rolling. Ethan?
Okay. Hi everyone, I'm Ethan, the founder of PolicyWorld. So these are some of the questions that we extracted from forums. And the first one is what happens at age 55 for Singaporeans for their CPF account? So the first thing that happens is the retirement account will be formed from your special account and ordinary account. And the order will always be take from special account because higher interest than your ordinary account. Then something changed also, your RSTU, which is the retirement sum topping up, will only go to your retirement account from now on. And the limit is up to ERS. But the tax relief limit is up to FRS only. So you have to take note of this. And for the withdrawal of your CPF account above your full retirement sum, the FRS, it follows through interest first, then contribution this year to your SAOA, then SA, then OA. So if you want to protect whatever is inside your special account, right, you can actually just draw the interest and the contribution that you contributed to the accounts this year. Or even better, just draw the interest. So your contribution will keep growing. Okay. So for the second question is about what happens once your special account reach full retirement sum before age 55. So when this happens, you can no longer do retirement sum topping up to your special account because the limit for this RSTU is FRS. And the RSTU can only be done after 55 when your RA is created. So if you understand what is the SA Shield, right, then you will be very happy that this can be done already. And number 3, your SA will still grow beyond full retirement sum through the voluntary contribution of the 3 accounts, or also known as CPF contribution if you are employees. Of course, your interest that is earned by a special account will continue to grow inside your special account. So that's how it works. Okay, so
I have a question for the
sure.
first Q&A.
Mm.
So does it mean that you cannot get tax relief after you hit FRS, but you can get tax relief for your MA contribution?
Yes, as long as your MA is below the basic healthcare sum and it is within the annual limit of $37,740. So like what we mentioned the last episode, you really need to make sure that it's within these 2 limits. Then there will be tax relief.
Okay, so the strategy to just nice hit FRS by 55 and hopefully not hit the BHS for MA would allow me to continue getting tax relief from MA top up from age 55 onwards.
Yes, that's correct. That's actually another way which especially employees they'll be very happy to know. If they did not do a retirement sum topping up, or they did very little before they reach age 55, right? They can also pledge their property to BRS plus a bit from your RSTU. So how much will you have inside your retirement account already then? If I pledge my property, BRS
That's half
plus
your
a bit,
FRS, no?
yeah, less than your FRS, then you created another stream of tax relief already through this way. But that is only applicable if you have not or did or and unable to make use of RSTU after that.
Okay.
Yeah, so it's very interesting. There are many ways to hack out a tax relief, but yeah.
Good to know.
Yeah. So without further ado, I think we'll continue with the content. So this is the table of contents for this episode. Okay, so what is the FRS full retirement sum? So why are we so interested in this? Then we'll talk about the accrued interest for CPF ordinary account, and more specific CPF hacks for self-employed. Okay, so what is FRS, the full retirement sum? So it's more of amount of savings to provide quite a basic needs in Singapore. And this is on the is a basis of a lot of rules in CPF. So it's like in order to understand CPF rules, the first thing you must understand is what is FRS. So what is FRS? It's actually a so-called expected minimum amount to be inside your retirement account after 55 to ensure that you have a good enough basic life for your retirement. And for BRS, actually 0.5x of FRS. So for example, if your FRS for this year is 100,000, so BRS is 50,000. And for ERS, which is the enhanced retirement sum, it's 1.5 times, which is 150,000. So FRS is like the basis of a lot of things. And it is the amount to be contributed to your retirement account before you can do any other kinds of movement to maybe from OA to MA, OA to other people's RA, to other people's SA, to whatever. So FRS is really a very important thing to learn. And that accompanies the BRS and the ERS. So understand FRS first. So now we'll talk about the accrued interest for CPF ordinary account. So for this accrued interest is actually the amount of money to be repaid back to your CPF ordinary account. So take it like it's a long-term loan on your own CPF ordinary account that you have to pay back. It compounds at 2.5%, and it will actually be accrued interest for the following, like mortgage payment when you use your ordinary account to pay for housing, and also for any student education loan. We'll elaborate this further on. And it does not limit itself to any kinds of annual limit or whatsoever, except for the amount of money that you take out from CPF ordinary account. So in a way, you can see it like it's a way to have, let's say you have an inheritance, you tilt 1 million total, then you want to have this money in a very secure account. You can use the accrued interest to pay back to your CPF in this case. And using this also means that whatever money that you use from your ordinary account, it should be able to beat 2.5% returns. That's why you take money. If you cannot beat, then you don't want the accrued interest. But if you can beat, you will want the accrued interest. Okay. So for the three of us, right, we actually had a student education loan. For me, I actually paid via cash. Okay, why is it so? Not that I wanted to, but I failed to convince anyone to take up bank loan or to use a CPF OA. But anyway, my parents did not have much CPF OA to use for education also. So that's why for my side, we have to pay via cash, but it's also not very nice because we actually loan from others to pay for it using cash. So imagine the irony. Yeah, yeah. David, what about you?
Okay, so for me, I did a tuition loan from the local banks. It's interest free, and interest only starts accruing 6 months after graduation. So the thing I like about it is that it's interest free, and because the loan is quite small, so it's also a good lesson to learn how to pay your loans at the beginning during your work life. It's good to know what it feels like to pay off a small loan, because thereafter you have bigger loans to service, like your property loans. And Jimmy?
Yeah.
Oh, hello. So for me, yeah, my university fee is paid using my dad's CPF ordinary account. So at that time, it was my dad who made the decision to use CPF OA, because uh, because at that time the funds from the CPF is not withdrawable. So since it's not withdrawable, so why not use the funds to pay for my university fee? Yeah. So that's the decision behind.
Yeah, so you can see actually there's various different reasons. Some for lack of financial literacy they do it lah, but some is with very good financial literacy that they do it. So we hope that the viewers here, if they ever look at this, learn to pick what is the financially savvy thing to do, which is actually to take the interest-free bank loan in this case, really. Especially if you have the money, because let's say if you are the person who took the tuition free interest loan, what will you do with the money? David, you are mute. You are muted. Yeah.
Oh, I would just put it into any bank to get 2 to 3% per annum easily without any risk.
Yeah. So look, it is actually a perfect way to grow your money to arbitrage. Yeah. So we hope
3 years is 10%. It's not a small amount.
Yes, correct. 10% is like if you have 10,000 is $1,000, right?
Normally 30,000 tuition loan, 10% is 3,000. No? Imagine it's your 1 month bonus now.
Yeah. So I don't know, but yeah. Okay, maybe let's move on. Okay, now we'll talk about CPF hacks for self-employed. Okay, so the first one is for most self-employed, they do not have medical benefits. They do have a lot of company benefits. So what you can do is actually use your MediSave account, which is also mandatory to contribute to buy an integrated shield plan. And in that, you reduce the amount of cash that you need for hospitalization insurance. And also for the rider, which needs to be paid by cash, right? You can take it with outpatient GP. So meaning to say that if you go and consult a doctor, right, your cash outlay instead of the usual $40, $30, or even $50 consultation, you can get it very cheaply at maybe $10 because of the tie-up with many of the medical clinics over there. So as long as you are visiting the panel, you just pay $10 for consultation, and it will be covered by the integrated shield plan. That's one way. I think currently we also have a lot of online medical MC. I don't know. They call it healthcare through the online. So they also bring the cost down to $10. So you can actually choose either online, which is ballpark no face-to-face, or you can go for the $10 consultation with face-to-face. So it's up to you to choose. So for self-employed, you have a variety of ways to keep your medical costs low in this way. Okay. So for the second part is it's more of playing with your cash flow. So for your Medisave account, you are always required to contribute, especially if you earn more than $6,000. So you always have an amount to be contributed to your Medisave account. But let's say if your income is very high, maybe at 50,000 a year, so you can actually use it to reduce your tax with the tax relief that is tagged to CPF tax relief. So if your this year's tax relief is very high, you can contribute this year. So you effectively shave off part of the income accessible this year for your accessible income for the next year. But let's say if your income this year is very little, near to zero, maybe 30,000 only. So with all the reliefs add up, you practically have nothing much to tax relief. So you may want to push the contribution later and put your money in some other place, depending on how you want. So it's more of a cash flow play, but it reduces your tax effectively if you know how to use this. So the key criteria is in December, maybe this year, you really know how much you earn. So you decide whether you want to contribute next year in January or this year in December for the tax relief. Okay, why I talk about January is because if you know that this year you are not going to contribute, next year you must contribute early to earn more interest in this case. True, it's calculated based on money. Okay. For the third hacks that we're going to share, it's more about voluntarily contribute to your Medisave for tax relief. So it's actually following the CPF annual limit of $37,740 or 37% of your income, whichever is lower. So in this way, you can actually get more tax relief. And if you do this right, in fact, you fulfill your mandatory contribution for the next year also. So let's say if your earning this year is 50,000, it drops to 20,000. And because of that, you don't wish to contribute more to your Medisave, So for that requirement, because when you earn 20,000, you still need to contribute maybe 1,000 or 1,500 to your Medisave account. But because you use this VCMA under the self-employed option, right, you contribute early to get the tax relief for this year. Next year, right, it also fulfills that 1,500 because whatever you need to contribute this year is only like 8% or 10% out of that 37%. So you effectively
so it's like credit lah. It's a
yes.
MA credit.
Correct. So it's a MA credit. So you do not need to pay Medisave for the next year because you already fulfilled it previously. So it's a credit to it. So in this way, there's a lot of cash flow that you can actually do. So if you understand how it works, right, you can actually help your cash flow. So that's why I feel that if you know how to play with your Medisave account contribution, your cash flow will be tremendous. It will be a better position if you know how to do this. Yeah. So now let's go to the bonus section. So it's why we say multi-pay CI is ECI plus CI. So maybe let's look at the characteristics of both. For multi-pay, normally what they do is upon first diagnosis, maybe early stage, they give out the first payout. Then intermediate, they give out the second payout. And there's a third payout based on late stage critical illness. And on the right side, we just talk about ECI, which pay out upon early diagnosis, and CI, which is a payout for late stage CI. So if you look at it in this way, the first payout and second payout, right, is more of like 200% ECI payout upon diagnosis in this sense. Then for the third payout, which is based on the late stage CI, it's actually the CI payout for late stage for CI. So that is why we think that really a multi-pay is CI is really like ECI plus CI. But at the end of all this, what is most important is what the cost savings. Yeah. So actually we did, for me myself personally, I did a few studies for multi-pay and ECI and CI. So what I found is if you want more affordable premiums and you think multi-pay is good, but the cost is really high. So how can you do this? So maybe for multi-pay, first payout upon diagnosis is ECI. So you can load your, okay, for multi-pay is about 300% coverage. So why not you can change your ECI to 100% coverage, CI to 200% coverage. So the cost, there will be substantial cost savings because CI is actually a lot cheaper than ECI. But obviously you can't claim so much also. But at least at the end of the day, 300% coverage is there. That is one way. The other way is you can buy 200% ECI and 100% CI. But normally the cost will be much higher than a multi-pay. But there is no confirmation for this. You must really do the mathematical sum in order to see which one actually save you more cost. So that is a train of thought that you can go about for this. So David and Jimmy, maybe you have any ideas or maybe thoughts on this?
Yeah, personally, I have both early CI and multi-pay CI.
Wow.
So to me, it's just having both cakes and eating them. So I have both of them. In fact, my multi-pay CI is it's a rider. I bought my life plan with CI, 200K each, and then I bought a multi-pay rider on top of it, which is 60K. So whichever happens, there'll be some payout. Yeah.
Yeah. What about Jimmy? Do you have any thoughts on this?
Yeah, because in the past, I mean, I met a few financial advisors, and then when they present to me the illustration of those critical illness plans, especially those, I noticed that those that pay out for the early stages, their premiums tend to be higher as compared to those that only pay out upon the later stage of the critical illness. Yeah, so so personally for me, I only have one multi-pay critical illness plans. Yeah, and I have that one for quite some years already. Yeah, still in force. Yeah. So yeah, I just noticed the premium is. I mean, as long as there's a cover for paying for early stage one, the premium is tend to be on the high side. Yeah. So it boils down to whether, I mean, I'd rather understand that yes, when you want a plan that covers early stage one, the premiums tend to be higher. Yeah. So yeah, that's all I would say. Yep.
Okay.
Oh,
so
for my early
me,
CI, right, I have I bought it through the SAF group term. So I bought the 1 million life coverage plus 50K CI plus 50K ECI. So that is quite affordable for now. Yeah.
Okay, Roger.
yeah. So for me personally, I don't believe in ECI right now.
Oh?
But that's just a belief. Because for me, as long as my health integrated shield plan, right, is actually at the private hospital tier, I'm not worried that I may not recover so early in this case. So that is my thoughts. Then that's how I can keep my cost low. There's a lot of ways to keep the cost low, and it depends on how you think of things. But of course, if there's a payout, it's an unfortunate event with money though. Yeah, so it really depends on what you think. That's why I load up a lot more in late stage CI because I don't want to financial ruin in this case. So I pay less, but a lot more coverage for a very improbable probability, but enough to tide me more than 7 years. So that's how I plan for myself.
Okay.
Yeah. Okay. So I think
Just curious, right? Because the CI for me, I have a more than 700k CI. My early CI and multi-pay is about 100k, so it's a 7 times difference.
yeah. So
What's your
that's
current CI at?
my current CI at. If I add them up all together, is 250.
Okay, is that enough?
For me, it's enough because my income expected income last time is 30 to 50k. So I already plan for that amount. So if in the event in the future that let's say I earn more than 50k, then I may adjust it upwards.
Okay.
So like I say, I always buy. I try to max the amount that I need so that I don't need to top up later on. That was my insurance planning philosophy. Yeah. So you can see it works out. It will definitely works out. And my liability is at this stage is going to increase, but the 7 years of income will never increase unless my income increases. Yeah.
So you buy based on your income, not based on your liabilities.
Yes.
Okay.
But for death, right, it's based on liabilities because I'm not around to even try to mitigate that already. There's no way for me to mitigate that. But for CI, I can. Yeah.
Understand.
Okay, so Jimmy, I think we have come to the end of the fireside chat. Yeah.
Okay, right. Thanks, Ethan and David, for the fireside chat. We hope you find it valuable for your own CPF accounts. So we are now go for the Q&A section. So if you have any questions with regards to CPF hacks, post your questions in the comment section as we are now addressing them. Yeah. So far, any questions?
Okay.
So far, there's no question. Unless, yeah.
Yeah, on my side, there is actually someone who asked this question because he's a sandwich generation, and he's thinking, is it prudent if he transfer his CPF ordinary account to his parents' retirement account? Yeah. So maybe Jimmy or David want to comment on this first.
David?
David, you're muted. Sorry.
Oh yeah, sounds very interesting. Because I was actually exploring this. It's one way to return your CPF earlier lah.
Return CPF earlier. Okay.
Right, because you transfer your OA to your parents' RA, and then obviously they are quite old and probably getting a payout from their CPF. So their amount will increase on a monthly basis. So yeah, it depends how much you transfer over, the amount would increase proportionately. So if you are currently giving allowance or whatever money to your parents, you can do it this way. Instead of giving the actual cash, move your OA to their RA account and let the CPF board pay them the amount. And on top of that, they get, I think, 4.5% minimum, up to 6% around there per annum. So you can't find this in any high interest savings accounts. Yeah.
Okay, I pretty much echo what David said. It's something which even I myself haven't really. I mean, didn't come across my mind. But I guess that the benefit is when funds is transferred to the parents' what RA account, is it? Retirement sum account, right? Yeah. So and there's interest to be earned in that account, like what 4+% per annum, right? Yeah. So I guess if you value that that interest gaining benefit, then that could be one option. Yeah, I guess.
Yeah,
Yeah,
but
so-
I think it's 6% for the first 30K and
Okay.
5% for the next 30K, and then
Oh.
4% for the remaining. Yeah.
Oh.
So it's really good. I mean, if okay, I don't know how much is in your parents' RA account, but if it's less than 60K, then yeah, please make it go beyond 60K. The interest is unbeatable.
I think it's fantastic. Where can you get risk-free rate of 6%?
Maybe you have to be a bank first, though. You become a bank.
No, but I mean like it depends on your own circumstances, right? Like if you have a plan ahead to that if you are willing to lock in the cash for that kind of return in the future, then yeah, that will be a plan. Yep. So I mean, never mind, Ethan. Yep.
No, it's more about when I look at this, it sounds like a fantastic plan, like when David and Jimmy, you guys talk about it. But I think there may be one slight issue. Because being the sandwich generation, right, when you do that, what are you effectively doing? Is you take your money, you give it to your parents. So you see where I'm coming from, right?
Okay.
Ethan, I thought technically you are already taking your cash money to pass to your parents. Is it the same thing?
Yes, but that one is money that you will have been inside your CPF account. So in this way, if you think about it, you're actually giving your money, your retirement money to your parents. That's one possible issue. If you look at it, you say it's a risk, especially if your parents are not using the money properly. And yeah, that's how I see it. So on theory, on paper, on mathematical calculation, it works fantastically because a lot of people say, please return my CPF. But yeah, this is one way. I don't know. It looks like it's the perfect way to return your money through this way.
I think it's a good thing because I assume that you have enough money in your SA for at least BRS. I mean, if you're working, it shouldn't be too difficult to reach BRS. And if you if you already can hit FRS, I think it's a very good idea to move some to your parents' RA. Yeah.
So it's more in the idea of reducing the amount of cash that you give to your parents in this way, and let someone else to automate the giving of this cash to your parents instead.
Yeah, you transfer the risk because if you give cash, one thing is cash is cash. There's no or not much interest on that. If you put it into their CPF, it's a lot of interest. I would say maybe 5 to 10 times interest, depending on how you get your interest.
Yeah. So are there any other questions? Yeah.
No, so far there's no questions. David, you have any questions?
We'll keep it for the next episode.
Okay, can. So with the interest of time, I think we shall end this episode. Going to end this episode. Okay. Right. So those of you that tune in, we thank you for tuning in. Feel free to post more questions in the comment sections, and we will address them during the next episode. right? So question with regards to CPF hacks. So Policy Work is on Facebook, YouTube, and Telegram. So if you wish to, you may connect with us through these channels. For Telegram, we are constantly updating the list of resale insurance policies that we have. So if you want to know more details about those policies, you may leave us a message on Telegram and we'll get back to you. Right? So we are open to anyone to join us on the Telegram channel. Right? So feel free to join us. So speaking of the next episode, join us next Friday, 5 p.m. for Jedi episode 11 on CPF hacks part 3. Okay. If you like our content and be notified for future episodes, do like our page on Facebook and share this Facebook Live video. So we hope to see you next Friday, 5 p.m. And may
the finances be with you.
Right, goodbye.
So, happy voting.